Good morning, everybody. Hope you had a nice weekend. It's Monday, March 30th. Thanks for joining the Alpha Pension Group Retirement Recap. We had a busy week in the markets last week. I'm going to turn it over to Rob, and he can tell us a little bit about what happened and what we might have coming this week.
It was a busy week in the markets, Rich. The U.S. equity markets closed the week on a down note on Friday, but that was after 3 days of positive returns. And on Friday, we gave back about 3 to 4%, depending on which index you were looking at. Overall, it was a very volatile week, but a positive week in equities. The S&P was up for the week 10.3%, and the Dow was up 12.8%. Another positive sign was that 3 out of the 5 days of the week were actually up. In the bond markets, we saw U.S. companies raising a record $109.1 billion through investment-grade bond issuance as corporate America really started to hoard cash. The record bond issuance came at a cost, however. The investment-grade bond index soared nearly 350 basis points over treasuries compared to a low of 100 basis points as borrowing costs for even the most creditworthy companies soared. So if you think about that, that spread represents how much risk the market is making companies pay in order to issue that debt. So those are the changes in the marketplace, and I'll hand it back to you, Rich.
Thanks, Rob. And I'll tell you what, we'll take flat futures. I know earlier this morning they were pretty negative, so maybe we can have a little bit of a recovery. One of the things that made the market as volatile as it was yesterday was the release of unemployment numbers. And if you take a look at the chart, a historic number of unemployment hit last week with more than 3 million filing for unemployment. The bad news is that it's expected that that number could reach up to 10 million. Hopefully this stimulus package that they passed last week will filter out to small businesses and we can curve some of those numbers. More details about that stimulus package are due today. Searching, as we are all trying to do, about some silver lining here is satellite images that show pollution clearing up. But if you take a look at, whether it be Italy or France or even Spain, the satellite images for the U.S. are not yet released. The amount of carbon in the air is reduced, and that's a good thing. Obviously, that means less air travel, less commerce, and that's not a good thing. So a little bit of a trying to search for a silver lining here. I'm going to turn it over to Mark Salamone now, who's going to talk about the CARES Act, which was a huge stimulus platform passed last week to relieve small businesses and Americans. Although there are some checks coming to Americans and stimulus for the average household, I want Mark to focus on the changes to retirement plans, which there are many, but Mark's going to walk us through the 3 biggest.
Yeah, so Friday was a big day. This well, I wouldn't say long, but it was an awaited legislation with a lot of hype and press beforehand because it does have a pretty significant impact on the economy and also retirement plans. So as it pertains to retirement plans, really 4 key issues and 4 things that participants need to know and that plan sponsors really need to understand is that participants now have a lot more access to their retirement plans than they had before. Traditionally, if you're going to take a 401k loan, you could take 50% of your balance up to a max of $50,000. That's now been changed to 100% of your balance up to $100,000. So significant increase there. You also have 12 months to delay payment on that loan, and that goes for everybody that has a loan right now. So if you have a loan right now, you have now 12 months to delay that payment, which for some that might be furloughed or maybe not getting the hours they used to, that could be a significant help to those participants. Distribution limits have been adjusted as well. Participants can now take up to $100,000 or 100% of their account balance. So completely liquidate the account if they have some sort of coronavirus issue. So for example, if they are in the situation where they're either sick or they have a family member that's sick or they've had their hours adjusted at work, they can take a hardship distribution up to $100,000 or complete 100% of their account, whichever is less. Last but not least, when it comes to required minimum distributions, those are waived for this year. So for 2020, those that receive required minimum distributions, that's that minimum amount that those over now age 72 have to take out. those participants now do not have to take that limit. They could take and delay that payment to next year.
Great, thanks, Mark. So on the two first points, the distributions, the loans and the actual distributions. So, I mean, I think we can all agree this is a good backstop, you know, a safety net of all safety nets. But at the same time, we need to be prudent here to say, you know, only take this if you have to, right? Particularly when it comes to the distribution. You know, you may take that distribution and think that you'll put it in. Again, I think, Mark, you said we have up to 3 years to put that back into the plan. Is that correct?
That's correct. So you do have some flexibility with how you pay distributions back if you don't want to take that hit all up front. So taking $100,000 out of a retirement plan, that's like receiving $100,000 of income. So that would be a significant taxable event. This legislation does give some flexibility with how you deal with that. You can delay it over 3 years. You can even pay back the distribution over 3 years. So participants are really going to consider, well, if I take this money out, how am I paying it back in? That is something, you know, that might creep up on some folks.
Yeah, and will I pay it back in, right? And I think that's the big concern that we have, is that we see that, you know, just, you know, human, you know, natural habits is you take it out with the best intentions, thinking that you might put it back in and you may not. So again, this is all good news, but we just need to be cautious that we're not setting ourselves up for disaster down the road by liquidating our entire retirement account. So maybe taking out small amounts instead of big distributions might be the best strategy.
I agree with that. The other thing is the loans. Loans right now, for a lot of plans, there's a lot of people with 401k loans that are existing. This is nice to be able to push it out a year, but during that time, the loan does accrue interest. And at the what would happen is the maturity date of the loan would be pushed out. So that's good for the people that need to delay that loan payment now. But for those that might be considering a $100,000 loan, you know, on a maximum amount, I mean, that's a significant payment they'd have to make every single paycheck. So a lot of things to consider when you're looking at your finances.
Right. So in order of distribution, I would say, of course, try not to, being the prudent, you know, retirement nerd that I am, right? Second, I would look at a loan, either delaying your loan payment so you could have better management of your cash flow, or taking a loan and kicking that out, you know, as far as you can. And lastly, taking distributions. And if you do hit that distribution piece, not taking out $100,000, taking out money when you need it, and hopefully being able to repay that over the 3 years time frame that we're now given.
I agree.
Excellent. So there's a lot more that goes into this CARES Act. We're taking this step by step, not only because some of the details need to be worked out, but also there's just so much to digest. So we'll be bringing more of this to you over the next couple of days. In the meantime, thanks so much for tuning in, and we'll see you tomorrow.